The average UK taxpayer is now projected to hand over £14,382 in tax throughout the 2025-2026 tax year, with frozen thresholds dragging millions of workers into higher tax brackets. The good news though is that with strategic planning, especially around income tax and capital gains, you could save yourself thousands of pounds. Now, before we get into tax saving strategies, let's understand what we're working with. And just a quick note, these are for people living in England, Wales and Northern Ireland. It is slightly different for people living in Scotland. So to help those living in Scotland, I will also share a link showing what these figures are for you in the description. For the 2025-2026 tax year, the personal allowance remains frozen at £12,570. This means that you won't pay any income tax on your first £12,500 of your earnings. Above that, you'll pay 20% basic rate on income between £12,571 and £50,270. You'll then pay 40% higher rate on income between £50,271 and £125,140. And then the 45% additional rate comes in at £125,140. If your income is approaching the 100k mark, please be particularly careful with your tax planning. When your income exceeds the 100k mark, your personal allowance does start to be withdrawn at a rate of £1 for every £2 of income above the threshold. This creates an effective marginal income tax rate of 60% on the income between 100k and 125,140, where your personal allowance is completely lost. Making pension contributions or salary sacrifice schemes to bring your taxable income below the 100k mark extremely tax efficient in this scenario. We will discuss this shortly. What's crucial to understand is that these thresholds have currently been frozen until 2028. This creates what economists call fiscal drag. As wages rise with inflation, more people are pulled into those higher tax brackets without actually becoming better off in real terms. The Office for Budget Responsibility predicts that 7 million people will pay the higher rate tax in 2025-2026, representing 2.5 million more taxpayers than if income tax thresholds had never been frozen. Then on the national insurance front, employees pay 8% on earnings between £12,570 and £50,270 per annum. And then this reduces to 2% on the earnings above that upper limit. So let's start with the simplest way to reduce your tax bill, and that's actually ensuring that your tax code is correct. Shockingly, nearly half of people who check their tax code discovered that they're actually on the wrong one. Most employed people in the UK should be on the standard 1257L tax code for the 2025-2026 tax year, which gives you the full £12,570 personal allowance. If you see different letters or numbers, that could indicate that there are adjustments that may or may not be correct. Common reasons for incorrect tax code include: number 1, not accounting for job changes; 2, outdated benefits in kind information; and 3rd, multiple income sources not being properly tallied. To check your tax code, you can look at your payslip, your P45, your P60, or alternatively HMRC's online personal tax account. Then if you think that your tax code is wrong, contact HMRC directly. Only 38% of UK adults know for certain that they are on the right tax code. With £8.2 billion in overpayments sitting in HMRC's accounts rather than people's pockets, this simple check could be very rewarding. Salary sacrifice arrangements can also be an effective way to reduce both income tax and national insurance contributions. This involves giving up part of your salary in exchange for non-cash benefits from your employer. Common salary sacrifice schemes include additional pension contributions, childcare vouchers, cycle to work schemes, and even electric vehicles. With the employee national insurance rate at 8% up to £50,270, salary sacrifice schemes effectively give you this additional discount on the benefit that you receive, on top of the income tax savings that you also achieve. For middle earners, exchanging £5,000 of salary for pension contributions could save you around £1,400 if you're a basic rate taxpayer, or 2.1 to 2.4k if you're a high rate taxpayer. Pension contributions remain one of the most tax efficient investments available to UK taxpayers. When you contribute to a pension, you receive tax relief at your highest marginal tax rate. Basic rate taxpayers get 20% relief. High rate taxpayers get the 40% relief, and the additional rate taxpayers get 45% relief. This means that a £100 contribution to your pension actually costs a basic rate taxpayer just £80, a high rate taxpayer just £60, and an additional rate taxpayer only £55. Pension contributions can be particularly powerful for those people that are about to hit a higher tax band to help bring yourself back below that. Remember that for the 2025-2026 tax year, most people can contribute up to £60,000 or 100% of their earnings, whichever is lower, to their pensions annually. However, this annual allowance may be reduced for very high earners or if you're already starting to draw from your pension pots. If you're married or in a civil partnership, don't overlook the marriage allowance. This allows individuals whose income is insufficient to make full use of their personal allowance to transfer this unused fraction to their spouse or civil partner up to a set amount. For 2025-2026, the maximum that can be transferred is £1,260. To be eligible, one partner must be a non-taxpayer or a basic rate taxpayer, and the other one must be a basic rate taxpayer. This means that the higher earning partner must not exceed more than £50,270 in the 2025-2026 tax year. This simple arrangement could save a couple up to £252 in tax per year. Not a life-changing amount, I know, but certainly worth claiming for what is essentially a 5-minute online application. ISAs remain one of the most powerful tax-efficient tools available to British savers and investors. For the 2025 to 2026 tax year, the annual ISA allowance stays at £20,000. This means you can put up to £20,000 into an ISA, and all interest, dividends and capital gains will be completely tax-free. Currently, you can put your entire £20,000 allowance into a cash ISA if you wish. However, there are rumblings of change on the horizon. The spring statement indicated that the government is considering cutting the cash ISA allowance to encourage more people into stocks and shares ISAs. If you are risk averse and you prefer cash savings, you might want to consider utilising the full cash ISA allowance while it's still available, because we don't know how long it's going to be here for. And remember, as of 2024, the rules for ISAs have now become more flexible. First, you can now open multiple ISAs with different providers in the same tax year. Second, you can now transfer part of your current year's ISA to another provider rather than the previous all or nothing approach. And third, there is no need to reapply for ISAs after gaps in contributions. These changes make it easier to chase the best interest rates across multiple providers, maximising your returns without losing the tax benefits. With the full 20k allowance available for stocks and shares ISAs in the 2025-2026 tax year and expected to remain, this remains an excellent approach for medium to long-term investors. Unlike cash savings, which often struggle to keep pace with inflation, investments in stocks and shares have historically provided better returns over long periods, though they do come with greater risk and greater volatility. Outside of ISAs, dividend income above the first 500 threshold is taxed at 8.75% for basic rate taxpayers, 33.75% for high rate taxpayers, and 39.35% for additional rate taxpayers. And then for capital gains outside of ISAs, above the £3,000 allowance, you are now taxed at 18% for basic rate taxpayers. This has actually gone up from 10% last year. And then 24% for the higher rate taxpayers. Again, this has recently increased from 20%. These tax rates make the tax-free nature of stocks and shares ISAs even more valuable. Now, if you're looking for a recommendation on one of my favorite stocks and shares ISA, it's got to be Trading 212. Personally, I love their commission-free trades and their user-friendly but advanced investing platform. If you'd like to consider using their platform and even get a free share worth up to £100 when you sign up, you can use the code DEAN as a referral code. In addition to Trading 212, I personally enjoy using Invest Engine for my more basic investment needs. This is the account that I have money auto deposited into each week, which I rarely check, rather than my day-to-day investing account, which is Trading 212. They're both really good platforms. Also, whatever platform you choose, please ensure that it has low fees to maximize your potential returns. Also, please remember when investing, you may get less money back than what you put in. So please don't invest money that you cannot afford to lose. If you hold investments outside of tax-wrapped accounts like ISAs or pensions, please be aware that the capital gains tax rates increased significantly in the recent budget, as we've just touched upon. Each individual has an annual CGT allowance of £3,000, though this has been significantly reduced in the last few years. Make sure you use your allowance each tax year by realising gains up to that limit. If you're married or in a civil partnership, consider transferring assets between you to use both of your personal allowances, and also to ensure that your gains are taxed at the lowest rate if one of you is a basic rate taxpayer. And also remember that losses can be offset against gains. So if you've made some losses on some investments, consider realising these in the same tax year as your gains to reduce your overall tax liability. While ISAs should generally be your first port of call for tax-free savings, don't forget about your personal savings allowance. This allows basic rate taxpayers to earn £1,000 of interest tax-free, and higher earners can earn up to £500 tax-free. With interest rates higher than they've been for many years, more savers are at risk of exceeding their personal savings allowance and facing tax on their interest. By strategically splitting your savings between you and your spouse and utilising both cash ISAs and ordinary savings, you can maximise the amount of tax-free interest that you have. With income tax thresholds frozen until 2028 and various tax rates on the rise, middle-class British taxpayers need to be more proactive than ever about tax planning. By checking your tax code, maximising your ISA allowance, making strategic pension contributions, and utilising allowances such as the Marriage Allowance, you can significantly reduce your tax burden. And remember, tax planning isn't about aggressive avoidance schemes. It's about understanding the legitimate reliefs and allowances available to you and making sure that you're not paying more than you should. A little time reviewing your tax situation could save you hundreds, if not thousands of pounds this year. Now, if you also want to understand how well your salary compares to the rest of the UK, watch this video here. Remember, when planning your finances, it's always best to speak to a financial advisor. This video is for informational purposes only and does not constitute personalised financial, investment or tax advice. If you found this video helpful, please don't forget to like and subscribe and also comment in the comment section. Until next time.